Good morning, everyone. Hope everyone's doing well. What a start to the week. It is March 13th here, second full week of March after last week we had an NFP report, we had Jerome Powell, we had the Fed, and in other news, we had three banks that actually failed over the course of the last week or so, we should say. So there's a lot of things going on right now, and the volatility is unprecedented in this market as we're turning lower and pushing through key areas very, very aggressively. So that's what I'm going to mainly talk about today. There's a lot to discuss, what to look for this week, how to play this out. How to not get killed. Wrapping up last week's live trading that we did in our Discord room. And this week, we're going to look to navigate this on a very risk averse perspective. Obviously, there's going to be a lot of opportunity, but there are a few things that you do need to know when trading these more volatile markets. So let's jump into this. There's a lot to talk about here, from the Federal Reserve to banks to whatever, everything, right? Overall, first things first, like I'm not a banking expert, right? Like I don't know this shit that well. I just know basic monetary policy, macroeconomics, and how to trade the market, assets, blah blah. But when it comes to like banking and what is going on in this sphere, it's something that yeah, okay, I understand balance sheets and whatnot, but it's something that I don't necessarily know too much about, right? I haven't been following these banks in every single minute detail of how they invest their loan book or their assets to the exact like tick. So um, I'm not going to pretend to be one of those experts that you see on Twitter. I'm just looking at what has been going on, what the Fed has been doing, and how this situation can unravel, right? Because last week Silicon Valley collapsed, right? We saw the collapse of Silicon Valley Bank, SIVB ticker symbol, and this was on Friday when they didn't even open their stock, right? They had halted pre-market and they just didn't open at all. So there was a huge questioning around depositors, right? A lot of people were going to the bank trying to pull money out. We have the FDIC, the 250K limit, right? Everything above that isn't protected, blah blah blah. And a lot of people were trickling into different banks and looking to actually take their money out, and a lot of depositors were fleeing just the general banking system, right? A lot of fear had spread throughout the market from this SIVB collapse, and this was, like I said last week, due to the investments in their bonds, mortgage-backed securities with those massive amounts that were at the beginning before the rate hikes, and those were adversely affected, causing losses. Now, the depositors last night were said to be made whole pretty much by the Federal Reserve, right? Adding funding available to eligible depository institutions to avoid damaging bank runs. So there was a lot of companies, including like Circle had like 3.3 billion. There was there was Roku that had a lot of money in there. There was a lot of massive companies that did have a lot of money in these banks, and the Federal Reserve pretty much bailed them out, making depositors whole in the SIVB situation. So that's what prompted the initial pop in the market yesterday. Overnight, throughout the overnight session, PNC Financial and Royal Bank of Canada explored bidding for Silicon Valley Bank as a federal deposit insurance court rushes to find a buyer for the failed lender. However, interest from two early suitors has since cooled. Meanwhile, HSBC, ring fence subsidiary HSBC UK Bank, acquired SIVB's British unit for £1. So Germany's financial regulator ordered a moratorium on SVB's Frankfurt branch, citing risks to the fulfillment of obligations to creditors, naturally. So SVB was shut down after withdrawal requests overwhelmed the lender, marking the second largest bank failure since the 2008 collapse of Washington Mutual. And Signature Bank as well was also closed, with regulators invoking a systemic risk exception. So overnight, the Federal Reserve, right, we had a lot of news that came out. I'll read some of this to you guys. And it seems like there is what looks like a quote unquote Fed pivot. There's also news that comes out of the ECB, blah, blah, blah. There's just a lot of news that happened that was pretty much sparked from the overnight session. So I'm just going back and seeing where some of this is right? Senior U.S. Treasury official, the cost of signature bank resolutions will not be borne by taxpayers. Again, depositors getting let go. The deposit insurance funds are fully sufficient, right? Pretty much the Federal Reserve just making the depositors whole. Now, another thing about this is that we have the CPI and we have the Fed and we have the FOMC meeting next week. So a lot of this was sparked by increased interest rates. Now, next week, we have the Federal Reserve FOMC meeting minutes where they're expecting changes in rates, right? This was based on last week's testimony from Jerome Powell, citing that inflation is still running high and the overall economy is doing well, so they can continue hiking rates. Now, that has since changed to now, by it seems every 10 minutes, the chances of a 25 basis point hike diminish. Now, 50 basis point hike for this meeting that's coming up in March is completely off the table, right? There's about 60% chance that we do have a 25 basis point hike and about 40% chance that we have no hike whatsoever that comes out in March. Things have shifted so much that people are pricing in now a 50 basis point cut by the end of the year based on what has been going on. So there's a lot of potential risk in this and volatility. Now, a Fed pivot, meaning that they're changing their tune in monetary policy from aggressive tightening. Now they're looking to even potentially ease into the end of the year. These things, when things aren't made whole, usually end in a pretty cataclysmic drop. So this could be the next run in the bear market where we could potentially see new lows in the overall market, right? This is going to spur a lot of volatility. We're going to see how markets open up and react today based on all this news that came out. Futures are down pretty aggressively. The last time I checked, which was like 4 minutes ago or something. Why don't we take a look now? They're still down pretty aggressively. They just popped off a little, but we also have what do we have? We have the CPI, right? We have the inflation data that comes out this week. So that's going to be very interesting to see how the Fed manages this whole situation, because this was turning into more of a political thing on the Fed side. And that's where they started to decide to make things whole and step in. So it didn't get a lot of damage and a lot of downside in the overall market. So with these financials, we're probably going to see some downside in the overall financials today. I think there's more downside in the market. I don't think there's going to be a crazy drop this week. I think that CPI comes out a little softer than expected. So things make a little more sense based on what the Fed might be doing. But to start the week, I am looking for a little more downside realistically. What else that we have here today? I want to take a look at the levels. So I've changed to the M contract on the futures. That's what I'm going to be trading. Huge area, 38.85, right? In and around that area, plus like 2 to 3 points. But 38.85 is a massive region, which opens up the distribution to the downside, where we could see prices. They've already traded almost to the lows, but 38.20 on the M contract is a huge target for me right now, failing around the 70. That's a region that I do want to take a look at. And then I'm going to be looking at those 50s. So as long as these like mid 50s hold on these futures, there could be some buyers, but I think they're just going to try to sell this. So pops into the mid 80s, right? Ideally, they hold the 70 and then see if some downside can come. I was looking at a pivot at 39.25, but that's very far away. If we reach that area, that's a pretty strong rebound, and realistically, the markets might see a little more upside. So with that being said, I do want to mention to you guys that this week on Wednesday, March 15th, on Wednesday, I'm going to be hosting a live at 4 p.m. Eastern time. It's going to be a Q&A. You guys can ask me anything. I'll present a few different little things for you, and I'm going to announce a huge announcement. So check that out. I'll see you guys there at 4 p.m. Eastern time on Wednesday. And massive Q&A. You guys can ask me anything. It's going to be a volatile week, so it's going to be perfect to present a few things to you guys and show you guys what's up. And last week, we wrapped up our full week of live trading that went extremely well in our Discord room. So if you want, you can check that out. I'm still posting in there, community.tradeproacademy.com, but I hope to see you guys in the room and check it out. I'll see you guys soon, and let's start off this week. I want to warn everyone, it's going to be a volatile week. It's going to be a volatile start. Trade smaller, look at wider stops, don't trade as much, don't blow the bankroll, and be very disciplined. Look at your risk management and really consider what's going on in the economy and this market. So thank you for watching, and I'll see you guys next time.